Ladies and gentlemen, good morning, afternoon, or evening. Welcome to my Tax Advisor Show. This is your tax guy. My name is Washira Joseph, and I run the most innovative tax consulting firm in Kenya, and that is the Career Tax Consultancy. So today, folks, I want to address a tax called capital gains tax. It is a tax that is charged on transfer of property, and specifically, we are talking of land, buildings, and marketable securities, all unlisted shares. So I'll be looking at what transaction constitutes transfer of property, who is eligible to pay this tax, who is not eligible to pay this tax, or who is exempted from paying this tax. And then I'll be showing you a demonstration on how you can be able to accurately compute your capital gain. And at the end, I'll be giving you my parting shots on the tax saving tips that you can use to protect your wealth and to reduce the tax burden. Come along. So, you've sold your property. And when I talk about property, I'm talking about land, buildings, and unlisted shares, or what we call marketable securities. And upon that disposal or transfer, you make a gain or a loss. So the element we are interested in is the gain, because that gain is what is going to get subjected to tax. No wonder the tax is called capital gains tax. You invested 10 million in land, you've sold that for 30 million. So you've made some gain of around 20 million. So that is what we are going to subject to tax. All right. So let us now see what is this that the law calls transfer of property. And the Income Tax Act, specifically the 8th schedule, regards transfer of property as either selling of that property. So a sale of a property constitutes transfer. Then exchanging the property, if you exchange your land in Nairobi with another land in Kisumu, that is a transfer of property, and it may be subjected to tax or not. The other one is the gifting of property. So you've gifted your friends or somebody, or so that gifting of property is an exchange or a transfer of property, and it is subjected to tax, subject to certain conditions. Then we have inheritance or succession. That is also transfer of property. We also have loss, destruction, or extinction of property, whether or not compensation is actually received. All right. And then we have abandonment, surrender, or cancellation or forfeiture of property, or the expiration of rights to that property. So there are certain transactions that are exempted to capital gains tax. They qualify as transfer, but they are exempted from being subjected to capital gains tax. For instance, when you transfer a property that is less than 3 million, then that is not subjected to tax. So the litmus test that I actually use is, if I have a transaction and that transaction is below 3 million, then I don't even go into the nitty-gritties of checking whether other parameters have been met. I just leave it at that point, and I know this transaction is not subjected to capital gains tax. All right, maybe it is subjected to other taxes, but not capital gains tax. So that's number one. Number two, which is not subjected to tax, is income that is taxed elsewhere. For instance, you have property dealers. They buy and sell land, they buy and sell houses. So the badges of trade for these people is that they are trading properties. So to them, properties are like goods and services that they're selling. So their income actually is not subjected to tax. But if you have a house that you buy a house one off or twice in a year, then you hold them for, let's say, 2, 3, 4, 5 years, then you are in the capital gain. You're waiting for the appreciation of price so that you can dispose of. But somebody who is constantly buying houses, buying land and selling it, they are in the trade, the business of buying and selling. So their income will be taxed elsewhere, and specifically in the income tax. Then we have sale of agricultural property or agricultural land that is less than 50 acres, and where that property is situated outside a municipality, a gazetted township, or an urban area. So if you're selling land below 50 acres, and specifically agricultural land below 50 acres, and it is outside a town, then that is not subject to taxation. You don't have to pay capital gains tax. The other aspect is transfer of property for purposes of securing a debt or a loan. Let's say, for instance, you're using your land as a collateral to get a loan with a bank. So you have to transfer that property to them. Now, that transfer is not a disposal. You're not selling that property. So that doesn't constitute a taxable transaction. So that will not be taxed, okay? The next one is transfer of inheritance or succession transactions. So a father or a parent transferring land to his children, that is not subject to taxation. Or to immediate family members, the law of taxation, the law of succession rather, outlines how that should be handled. So the succession transactions are not subject to capital gains tax. That is very important to note. The other one is transfer of asset between spouses. All right. So if you're moving assets to your wife, that is not subject to capital gains tax, whether it is the wife or the husband doing that. And for your information also, if you are transferring asset between divorced spouses, those transactions are also not subject to capital gains tax. They were spouses at some time, so those transactions are not subject to capital gains tax. The other one is where you transfer property to a company where spouses or a spouse and immediate family members hold 100% shareholding. So essentially, people are fond of, in a way to protect their assets and to shield themselves, they move their property from themselves to their own companies. A company is a separate legal entity. So, we live in a litigious environment. So even if you are sued, you will not lose what is in the company. So in a way to protect and shield yourself, so the assets that you move to a company that you own 100%, then that does not constitute a taxable transfer of property. And last but not least is one transfer of one private residence where individual owner has occupied the residence continuously for the 3 years period immediately prior to the transfer. So what that means is you've been occupying a house for the last 3 years or a home for the last 3 years, and then you dispose that home. Then even if it's above 3 million, you don't have taxes to pay on that because that is a residential property. And this is one of the tax planning tricks that a lot of people should be using. And you can use it actually to grow wealth. You can grow 10 million to 20 million. Then you can sell that from 20 million to 30 million. You can be able to grow wealth using this clause here. So make sure you occupy it for 3 years at least, and then you dispose it off. So how do we compute capital gain? So how do we know that an asset has actually appreciated or depreciated? The way we do that, we look at the net transfer value. and then we minus the adjusted cost of property. So the net transfer value, here's how we do it. So I've sold a property for 10 million. That is the amount that I'm gonna get from the buyer of my property. But before selling that property, I've had expenditures to facilitate that sale. I've had to pay lawyers, I've had to pay agents to look for me a buyer. So I've had to advertise it so that I can get a buyer. So all those expenditures, you remove them from the transfer value. So essentially what you have is the net transfer value. The other one is the adjusted cost of property. So the adjusted cost of property is, I bought this property for 5 million, for instance. And then this property, when I was buying it, I had some expenses. For instance, I had to pay a lawyer, I had to pay a valuer, I had to pay surveyors to establish beacons, and so on and so forth. And then after buying that property, I've done enhancements to that property so I can be able to preserve value. I've dug boreholes, I've planted trees. So I've elected the fence. So all those expenditures, you add them together and they form what we are calling the adjusted cost of property. So let me go deeper into each of them. So let's start with the net transfer value. And what we've said is you look at what are the sales proceeds that I'm getting from the buyer. So this is the total payment from the buyer. And then you deduct incidental cost or reasonable cost that you incurred in the process of selling that property. And this incidental cost can be things like legal fees or professional fees. You paid a lawyer, you paid an accountant to prepare your books, to consolidate records, you paid a valuer, all those costs, You have also incurred costs of advertisement to find a buyer, all right? You've paid an agent to get you a buyer. So the commissions that you pay them are deductible, all right? You've paid valuers to help you know the current market price of the property. So the net effect of that is going to give you the net transfer value. So that's how we go about computing the net transfer value. Then we have the adjusted cost. And the adjusted cost, we said, you look at the cost of acquisition of the property, and then you add relevant costs associated with the purchase of that property, all right? And then you also look at the enhancement costs that you have incurred in preserving the value of that property. So some of these relevant costs, you can have professional fees. You pay an accountant, you pay a lawyer to draw agreements, you pay surveyors, you pay valuers, agents. And then we have property enhancement cost. You've dug a borehole, for instance. You've built a pathway or a road inside your property. So all these enhancement costs are deductible, or you can add them into your property costs. The other one are the cost of defending the title. Then the other one is loan and mortgage interest. Let's assume that you took a loan to purchase this property. So the interest that you've been paying, they constitute the cost of that property. So you are allowed to deduct them. The other one is the stamp duty. So the stamp duties that you paid, you're gonna add them here. And then the last one is the capital allowances that you've already claimed. For instance, if it's an industrial building, then you've been claiming industrial building deductions. You cannot claim them twice, so you'd have to deduct them here. So in a nutshell, That's how we compute the adjusted cost of property. So what is the capital gains tax rate? Beginning January 1st, 2015, which is actually when this act was reintroduced in Kenya, to December 31st, 2022, the rate of tax is 5%. Then there has been changes that were brought up by the Finance Act of 2022 and to change the rate to 15%, and this is going to take effect from 1st January 2023. As at the time of recording this video, which is November 2022, the rate of tax is 5%. So if I was planning to sell a property, I would sell it right now or between now and December 31st, just so that I can save a bit of taxes, around 10% in taxes. So, but if you're watching this video after 2023 January, then the rate of tax for you is gonna be 15%. Two things to note. Capital gains tax is a final tax, and what that means is that income is not gonna get subjected to any other tax. And also what that means is you cannot offset this tax against other taxes. All right. For instance, you cannot offset this tax against your income tax. The other note that I want you to note is that the capital losses can be carried forward against future capital gains. So let's say that you sold a property at a loss. Then the next time you sell a property at a gain, you're just gonna deduct the loss from those gains, and then they're gonna reduce your taxes. So when is the tax paid? The tax is paid on or before the transfer of property, but not later than 20th day after the transfer. So the best practice here is a transfer is not complete until exchange of documents have taken place or the transfer of title has taken place. So make tax payment after the transfer but before the 20th day. And these are all done online on iTax. They're not physical submissions. So we've come to the end of the presentation, my viewer. And if you're looking for help in preparing your capital gains taxes, or you're looking for tax saving strategies on your real estate, I am your go-to person. I'll be able to give you ideas on how you can be able to save the most taxes the legal way. Till next time, my viewer, be safe. Joseph.